welcome to your deep dive. If you really want to understand the economic engine powering one of the world's most dynamic and fastest growing economies, India, well, you have to understand its financial pulse. Today, we are diving deep into that pulse, the Sensex.
The Sensex, yeah, or the sensitive index. It's absolutely central, to the story of modern Indian finance.
Yeah.
It really is the benchmark index of the Bombay Stock Exchange, the BSE.
Right.
And it's the most widely tracked indicator of market sentiment and just overall economic performance in the country. It's essential reading for anyone tracking emerging markets.
Our mission today is basically to transform your understanding. We want to go beyond just recognizing the number you see on the ticker.
Yeah.
To truly appreciating its, let's say, architectural complexity and its historical significance. We're going to take your stack of sources, distill exactly what the Sensex is, from its memorable name to its rigorous calculation methods, and chart its incredible, sometimes volatile journey through decades of booms, scams, and global crises.
That's the plan.
We really want you to walk away with a true expert understanding of this critical benchmark.
And, just to immediately grasp the sheer scale of this index's journey, let's maybe look at where it stands today. As of October 29, 2025, the BSE Sensex closed at 85,037.08 points.
That figure. It's just staggering when you think about where it started. We're talking about an index that officially began tracking at just 100 points.
Right, derived from data collected way back in the late 1970s.
Okay, let's unpack this then, starting with how this powerful index even got its name and, where it lives.
Yeah, the name. It's funny, for an index representing billion, maybe trillions in market value, the name itself has a surprisingly simple, almost whimsical origin story. Sensex is actually just a straightforward portmanteau.
A portmanteau.
Yeah, a combination of two words, sensitive and index.
Sensitive index.
Yes.
Sensex. Okay.
Yeah.
And that blend was important.
Crucial, yeah, because the original official title was, let's just say it was a bureaucratic nightmare. Bombay Stock Exchange Sensitive Index.
Suckles doesn't exactly roll off the tongue.
Not at all. It was actually coined by a stock market expert, Deepak Mahoney, back in 1989. The core idea, his thinking was, the index must be sensitive to the slightest market movements. Hence the focus on sensitive.
So he just shortened it.
He shortened it, and the name just stuck instantly. Much more marketable, much more memorable.
Makes sense. So before we dig into the companies inside it, you mentioned the Bombay Stock Exchange, the BSE. We need to set the scene there, right? This isn't some new exchange.
No, not at all. The BSE has a profound history. It was established way, way back in 1875. That makes it Asia's first and oldest stock exchange.
Wow, 1875. That historical context is massive.
Yeah.
So Sensex isn't tracking some new experimental market. It's tracking the oldest exchange on the continent.
The oldest, and now paradoxically also touted as the world's fastest. It operates at a stunning technological speed of 6 microseconds.
6 microseconds. So it's this hub of deep history and cutting-edge technology.
Okay.
So mechanically speaking, what is the Sensex?
Mechanically, it's defined by its exclusivity. It's a very select basket. Just 30 well-established and financially sound companies listed on the BSE.
Only 30.
Only 30. And these companies aren't just, random large entities. They have to meet very specific, quite demanding criteria to earn their spot.
And we often hear them called India's blue chip companies, right? That implies they're the most reliable, profitable, respected names.
That's the implication, yes. They represent the sort of bedrock of Indian corporate strength. And critically, this selection of 30 isn't random at all. They're meticulously chosen to be representative of various critical industrial sectors across the Indian economy.
So like banking, manufacturing.
Banking, manufacturing, pharma, IT, you name it. This is how they ensure the index truly reflects national economic trends, not just, say, what's happening in the tech sector alone.
Okay, let's nail down some core baseline facts then. The history. You said the data goes back, but when did it officially start?
Right. The official foundation date when the formal index calculation began, that was January 1st, 1986. But crucially, the historical data it's anchored to is much earlier. The base year used for all calculations is 1978-79.
78-79, got it. And the starting value.
In that base year, the index was assigned a conceptual base value of 100, just 100 points.
So that 100-point starting line tracked from 78-79, that's the benchmark against which all this growth, up to 85,000 points today, is measured.
Exactly. And that's also an important piece for international capital. For those dealing in foreign exchange, the BSE actually launched a dollar-linked version called DolX. That was on July 25, 2001.
DolX, Dollar Index. Okay, so we've got this index, 30 blue chip stocks, Asia's oldest exchange, starting conceptually at 100 points back in the late 70s. Why does this number matter so much? What's its main function in the financial world?
Well, its function really comes directly from its composition and how it's calculated. It's consistently regarded almost universally as the pulse of the domestic stock markets in India,
The pulse.
because it's designed to be sensitive and representative.
So simplifying it for, say, the everyday investor, if the Sensex is going up steadily, that's a good sign, positive sentiment.
It's a very strong signal, yes. It generally means share prices across the broader market are moving up, maybe driven by good corporate results, strong economic data, political stability, things like that.
And conversely, if it's declining.
That suggests a market-wide correction or maybe pessimism creeping in. Investors are generally selling, stock prices are falling, and because those 30 companies are drawn from all the key high-impact sectors,
Right, the diversification.
the index doesn't just measure stock performance in isolation. It provides a pretty robust, real-time insight into the overall health, and maybe more importantly, the forward-looking sentiment of the Indian economy as a whole.
So it's like the country's financial mood ring, almost.
That's a good way to put it. Yeah, the closest thing India has to one.
Okay, now let's get into the engine room. The methodology. This often gets overlooked, right? But it's the absolute secret sauce to the Sensex's credibility. The method determines the number. If the method's flawed.
The number is meaningless. Exactly. An index calculation, it's dynamic. It evolves. When the Sensex was first launched back in '86, it used a relatively straightforward weighted methodology. It was based on full market capitalization,
Full market cap, meaning
the index value reflected the total value of all shares issued by those 30 companies. Simple multiplication.
Okay, but the financial world started moving towards something else, right? Your sources highlight a major reform. Since September 1st, 2003, the BSE switched entirely to the free float market capitalization method.
Yes, and this change was monumental. Absolutely huge. It brought the Sensex in line with major global benchmarks, the ones provided by international index giants like MSCI, FTSE.
Why the change, though? What was wrong with the old way?
Well, the older full market cap method, it was considered increasingly inefficient, maybe even misleading, because it included shares that were realistically never going to trade.
Like shares held by the founders.
Exactly, or large government holdings. These weren't readily available on the open market, so including them could potentially distort the index's reaction to real supply and demand dynamics.
Okay, so let's spend a moment really deconstructing this free float method. Start with the basics again. Market capitalization. That's just stock price times the total number of shares issued, right?
Simple as that. Stock price X total shares outstanding.
So where does the free float concept come in? How does that change things?
This is where the index gets its accuracy, its sensitivity. Free float refers only to the proportion of those total shares that are readily available for trading by the general public. It effectively filters out the noise, the locked up shares.
And this filter is key to that sensitivity we talked about. So crucially, the free float calculation doesn't count what you called restricted stocks.
Correct. It excludes them.
And who holds those? Like company founders, insiders.
Shares held by promoters, company insiders, shares involved in cross-holdings between related companies, or, very significantly in the Indian context, large blocks of shares held by the government in strategic enterprises. These just aren't available for sale in the ordinary course of market events.
Right. If you think of an index as reflecting tradable value, why count shares that haven't moved in decades and probably won't anytime soon?
Precisely. They're locked up. They're not part of the daily supply and demand equation that actually drives price discovery and volatility. Excluding them makes the index value a much purer reflection of active investor sentiment and market movement.
Okay, so how do they quantify that? How much is locked up versus free? That brings us to the free float factor, I assume?
Exactly. The free float factor is simply the ratio. It's the number of those floated shares, the ones genuinely available to the public, divided by the total outstanding shares.
So, like, if a company has 100 shares total, but the founders and government hold 60.
Then only 40 are available for trading. So the free float factor for that company would be 40 divided by 100, or 0.4 or 40%.
Got it. And once you have that factor for each company.
Then the calculation becomes quite manageable. You calculate the free float market capitalization for each of the 30 companies. You just multiply its overall market cap, Sensex total shares, by its specific free float factor.
Okay, so you get 30 individual free float market caps. Then what? How do they combine into the single Sensex number?
Right. Now we take those 30 free float market caps and plug them into the main Sensex calculation formula. This is the critical part.
Lay it on us. The formula is
Sensex equals the total free float market cap of all 30 companies summed together, divided by the base market cap, and then that whole ratio is multiplied by the base index value, which we know is 100.
okay, total free float cap divided by base market cap times 100. It's basically a ratio comparing today's tradable value to the starting value back in 78, 79.
That's exactly what it is.
And that denominator, the base market cap, is that number fixed.
It has to be. It's the mathematical anchor. The sources specify this crucial constant value is Rs 2501.24 crore.
2,501.24 crore rupees. Why is that specific number so important to highlight? It feels like trivia, but is it?
It's definitely not just trivia. That divisor, that 2501.24 crore, serves as the constant historical weight of the index back in 1978-79. It ensures that the current Sensex level is always a direct apples-to-apples comparison to that base period, even as the actual value of the companies today has multiplied thousands of times over.
Ah, I see. Without that fixed denominator, the calculation would kind of drift. Every time a share price changed, it wouldn't be anchored to the start.
Precisely. It would become internally inconsistent. This methodology ensures the Sensex is a constant, real-time measure of the combined tradable wealth of these 30 companies relative to their starting point.
And given the BSE speed,
Oh.
you said 6 microseconds, how often is this calculation done?
It's updated constantly. The value is calculated every 15 seconds and disseminated in real time throughout market hours. It's about as immediate an economic report card as you can possibly get. Hashtag IV, the constituents, and the gatekeepers.
Okay, so if the index is built on just these 30 companies, that implies they are the absolute elite, the creme de la creme. The selection process itself must be incredibly rigorous then. Who actually gets to decide who's in and who's out of this prestigious club?
Yeah, prestigious club is a good way to think about it. The selection criteria are overseen by the S&P BSE Index Committee.
S&P, BSE, so it's a joint effort.
Well, S&P Dow Jones Indices manages many global indices and collaborates with the BSE on this. The committee itself is composed of leading capital market experts, academics, finance professionals. They act as the gatekeepers.
And their choices must dramatically influence the visibility, maybe even the valuation, of any company they select or deselect.
Oh, absolutely. Inclusion is a huge deal.
So let's examine those criteria. What does it actually take to be considered a blue-chip company in India, according to this committee?
Okay, first, there's the basic administrative stuff. Listing. The company must be listed on the Bombay Stock Exchange, obviously, and it needs to have been listed for at least 1 year. Can't be brand new.
1 year minimum?
Yeah.
Makes sense. What else? Size must matter.
Immensely. Second is market capitalization. The Sensex is not a small cap or mid cap index. Constituents must be large cap or mega cap stocks. Specifically, they have to rank in the top 100 companies by full market capitalization across the entire exchange.
Top 100 by size. Okay,
Yeah.
Then what?
Then we get into liquidity. This is crucial for a real-time index like this. The companies have to be heavily traded. The criteria demand that the security should have been traded on almost every single trading day for the last year.
Wow, almost every day. That's strict.
And there's a quantitative measure for that, too. The firm must also be in the top 150 firms listed by average number of trades and average value of shares traded per day.
So it's not just about having shares available, like free float tells us, but about those shares actually changing hands frequently and in large volumes.
Exactly. High liquidity is vital. You don't want an index built on firms where only a handful of shares trade each day, because that would lead to erratic price jumps and wouldn't reflect broad market activity. High liquidity ensures the Sensex is reflective of deep, consistent trading reality.
Makes sense? Are there qualitative checks, too? Beyond the numbers?
Yes. There are criteria to ensure financial stability and business quality. The company must generate earnings from its core activities. This helps filter out maybe purely speculative ventures or companies with unusual income structures.
So real businesses making real money.
Pretty much. And a very important mandate is that the selection overall must contribute to keeping the sector balanced in line with the country's broader equity market.
Ah, sector balance. That seems key if it's meant to be a pulse for the whole economy.
It is. The committee actively tries to avoid overweighting a single industry. Even if that industry happens to be booming or contains several very large companies, they need the mix to reflect the overall economy's structure.
And finally, any sort of gut check.
There is, actually. The final criterion is that the firm should have an acceptable track record, in the opinion of the Index Committee. This blends all the objective trading data and financial metrics with a subjective expert judgment on things like management quality, corporate governance, future growth potential.
So it's data plus expert opinion.
Okay.
Now, a critical question comes up here. If it's only 30 companies, doesn't that make the Sensex quite susceptible to, say, single company risk or single sector risk? How accurate can it really be as a pulse for the entire, very diverse Indian economy with just 30 names?
That's definitely the inherent tension, the trade-off at the heart of the Sensex. By definition, being just 30 stocks, it is much more concentrated than, say, the 50-stock Nifty Index, which we should probably touch on later.
Yeah.
And when you look at the resulting sectoral representation in the Sensex, that concentration becomes pretty clear. #B, sectoral representation and review. Historically, and even today, the index is heavily influenced, heavily weighted towards the finance sector. We're talking large banks and the big non-banking financial companies, or NBFCs.
And after finance.
Information technology comes a close second. If you think about India's growth story, especially since the economic liberalization in the 1990s, it's been fundamentally driven by IT exports and the expansion of financial services. The index reflects that reality.
Yeah, you see that reflected in the typical constituent lists, right? They're anchored by absolute powerhouses. We're talking about Reliance Industries, HDFC Bank, Tata Consultancy Services, TCS, ICI Bank, Infosys.
Exactly. Those handful of stocks, because of their massive free float market caps, often account for a disproportionately large percentage of the index's total movement on any given day. A big swing in Reliance's price can move the whole Sensex significantly.
So how do they manage this? The economy changes, sectors rise and fall. How does the committee keep the index relevant?
They have to be constantly vigilant. To manage this constant shift in economic priorities and company fortunes, the Index Committee cannot just set it and forget it. They actually meet every quarter to review all the indices under their purview, including the Sensex.
Every quarter they meet. But do they make changes that often?
Not necessarily wholesale changes every quarter. While they meet quarterly for review, the formal changes that actually impact the index composition usually happen through a more rigorous, scheduled process. The composition typically undergoes a formal half-yearly reconstitution.
Half-yearly? When does that usually happen?
Usually scheduled for June and December. This constant review and periodic reconstitution is absolutely necessary. The index must remain a current and accurate representative of the current market power structure, not yesterday's. #TAG-C. The constant state of flux index changes.
Okay, and this is where the Sensex really tells the story of India's changing industrial landscape, isn't it? It's like a living, breathing financial entity that reflects the rise of new sectors and sometimes the fading of others. It sounds like an ongoing economic drama.
It really is. You can trace India's shifting economic focus, its priorities, just by looking at some specific removals and replacements that the sources highlight over the years.
Give us some examples.
Okay, back in August 2011, for instance, we saw Reliance Communications and Reliance Infrastructure, both part of the wider Reliance Group. Then they were replaced by Sun Pharma, a major pharmaceutical company, and Coal India, a state-owned mining giant.
So a shift away from certain types of infrastructure or telecom placed towards pharmaceuticals and basic resources.
Seems like it, yeah. Now, moving into the more recent digital era, technology stocks are, as you'd expect, a constant battleground for inclusion and dominance within the index. December 2018 saw a pretty major shift when Wipro, a legacy IT giant.
Household name.
Absolutely. Wipro was replaced by HCL Technologies. This shows that even among the established blue-chip IT players, relative performance, growth trajectory, and crucially, that tradable free-float dominance are always under scrutiny. You can't just rest on your laurels.
And what about reflecting turbulence? Sometimes companies fall out of favor for other reasons.
Definitely. December 2019 was quite notable in that regard. Vedanta, a diversified resources company, and Yes Bank, which was facing significant financial stress and governance issues at the time.
Right, that was big news.
Huge news. They were both removed and replaced by companies representing consumption and lifestyle strength. Nestlé India, the food giant, and Titan Company, known for jewelry and watches. The index committee effectively replaced old economy or troubled firms with robust, high-growth consumer brands, reflecting where investor confidence was moving.
But the truly profound signals, perhaps, come from the most recent changes, the ones that really seem to reflect India's modern economic priorities.
I think so. Consider the changes that were set for the second half of 2024, according to the sources. JSW Steel, a traditional heavy industry giant.
Steel, classic old economy.
Right. JSW Steel was replaced by Zomato Ltd.
Zomato, the food delivery and restaurant platform, that's a massive shift.
It's a defining moment, really. That single substitution shows the index is actively pivoting towards the digital consumer economy. It's an acknowledgement that growth in India is increasingly going to be driven by these kinds of technology platforms, not just heavy industry anymore.
And there was another big one around the same time.
Yes, the addition of Adani Ports and SEZ in June 2024. They replaced Wipro, actually. This emphasizes the colossal, ongoing national focus on infrastructure development, logistics, ports, supply chain efficiency.
So the Sensex, in its current form, looking at these recent changes, it seems to be communicating that India's growth future is heavily defined by finance, yes, but also IT, critical infrastructure, and the digital consumer.
That's a very good summary. It's no longer just a reflection of 30 established, maybe somewhat static firms. It's become a much more dynamic mirror of where the economy is heading. #TAG-V. A journey through milestones and volatility.
All right, let's embark on the history now. This is the high-stakes narrative that takes us from that conceptual 100 points back in 78, 79 to over 85,000 today. And this story, as we've hinted, is really defined by policy reforms, sudden scandals, moments of national euphoria, and global shocks. #LAs. Early growth based at 10,000 points.
The initial growth, looking back, was fairly steady, but relatively slow compared to recent decades. The Sensex actually took 11 years from its formal foundation date in 1986 just to hit its first major four-digit milestone.
11 years to get to 4 digits, which was...
That milestone was 1,000 points, reached in July 1990. And the drivers back then were quite fundamental, quite old economy, you might say. A good monsoon season.
Which is still hugely important for the wider Indian economy.
Absolutely. Crucial for the agrarian base. That, coupled with strong corporate results, pushed it over the 1,000 mark.
But the 1990s were also the era of explosive liberalization, right? Which came with risks.
Huge risks alongside the opportunities. It crossed 4,000 points in March 1992. This was boosted by major economic policy initiatives under Finance Minister Manmohan Singh, expectations for a much more open trade regime. A lot of optimism.
But that high point, March 92, it came with an immediate and, frankly, catastrophic consequence. The infamous Harshad Mehta scam blew up right then.
Exactly. The market euphoria just evaporated overnight. It was replaced by panic, investigations, and what the sources describe as unabated selling. The index crashed spectacularly as trust in the market integrity just vanished.
That scam. It feels pivotal looking back.
It really was. It demonstrated the extreme fragility of the early, newly liberalized Indian market. And importantly, it spurred major regulatory overhauls by the newly formed SEBI, the Securities and Exchange Board of India, aimed specifically at preventing market manipulation and ensuring fair trading practices. It was a massive systemic lesson learned the very hard way.
Okay, so the market recovered eventually. What was the next big psychological barrier?
That came near the end of the century. 5,000 points, reached in October 1999. And interestingly, this rally was specifically driven by political optimism. It coincided with the BJP-led coalition winning a stable majority in the Lok Sabha election.
So stability. Clearly highly valued by the market then and now.
Always, uncertainty is the enemy. Then, the turn of the millennium was completely dominated by the global IT boom, the dot-com bubble. This era drove the index up to 6,000 points in February 2000.
6,000 in the IT boom.
Yeah.
But what's fascinating, according to the sources, is how long that peak lasted.
Yeah, that 6,006-point record, it actually held for nearly 4 static years, until January 2004, which really highlights a long period of stagnation or consolidation that followed the bursting of the global tech bubble. India wasn't immune to that either.
Then momentum seemed to gather pace again mid-decade.
It did. The index crossed 7,000 points in June 2005. And one of the unique drivers mentioned here, quite specific to India, was the formal public settlement in the Ambani family feud.
The Reliance split.
Exactly. That triggered immense gains for the various Reliance Group companies as years of regulatory and ownership uncertainty finally lifted. Clarity equals confidence.
So the period between 2005 and 2006, was that when foreign money really started pouring in?
That was a key period. It was defined by brisk, consistent purchasing, primarily fueled by the aggressive entry and expansion of foreign institutional investors, FIIs, and also the rapid growth of domestic mutual funds tapping into India's rising middle-class savings.
And all that buying power drove the Sensex to its first 5-digit milestone.
Finally, yes. It was achieved on February 7, 2006. The Sensex closed above 10,000 points. That moment felt highly symbolic. It signaled that the Indian economy was now really functioning at a global scale, capable of attracting truly massive international capital flows. #B. The bull run and the global financial crisis, 2007-2010. Okay, if the run up to 10,000 felt significant, the speed of the subsequent rally was, well, truly unprecedented. It reflected an almost manic euphoria among investors, both domestic and foreign. The index doubled again, from 10,000 to 20,000 points in just under 2 years.
Doubled in under 2 years. When did it hit 20K?
It closed above 20,000 on December 11, 2007.
And the sources highlight just how intense that momentum was during 2007 itself. Right? Like some of those 700-point jumps were incredibly fast.
Extremely fast. The climb from 16,000 to 19,000 points, for example, took only 17 trading sessions. That stood as a historical record for the fastest 3,000-point rally for a long time. But, that level of speed inherently builds fragility into the market. Things felt overheated.
And the fragility became apparent very quickly.
Yeah.
Let's focus on the volatility triggered by something called the P-note crisis in October 2007. SEBI, the regulator, proposed curbs on these instruments known as participatory notes, or PNs.
Right, P-notes.
For our listeners, maybe just quickly explain, what exactly were these participatory notes and why did restricting them cause such instant panic?
Sure. PNs were essentially derivative instruments. They were used mainly by foreign investors, think hedge funds, large global institutions who wanted exposure to Indian stocks, but for various reasons didn't want to register directly with SEBI in India.
So how do they invest?
They would invest through an already registered foreign institutional investor, FII. The FII would buy the underlying Indian shares and then issue a P-note to the end beneficiary, effectively giving them the economic benefit of owning the stock without the FII having to disclose the ultimate owner's identity to the regulator.
So the core issue was anonymity, transparency, stability.
All of the above. SEBI was getting nervous because they didn't know who the ultimate owners of potentially huge stakes in Indian companies were. They worried that massive amounts of unregulated capital, what people sometimes call hot money, could flood into the market and then wash out just as quickly, destabilizing the entire system. SEBI wanted to get a better handle on these flows, control the risks.
But they proposed curbs.
Exactly. It was just the proposal of curbs, not even the actual implementation yet. But the market reacted with immediate and really dramatic panic. On October 17, 2007, literally within 1 minute of the market opening, the Sensex crashed by 1,744 points.
1 minute. How much is that in percentage terms?
It represented nearly a 9% drop. At that time, it was the biggest intraday absolute point fall ever recorded, and it immediately triggered the mandatory automatic suspension of trading for 1 full hour. Circuit breaker hit.
Wow. The lesson there seems to be that any perceived threat to the flow of foreign capital, even just a regulatory suggestion, could paralyze the market back then.
Absolutely. The government, through the finance minister, P. Chidambaram at the time, had to intervene almost immediately with clarifications, basically reassuring FIIs that they weren't planning to ban PNs outright, just regulate them better, understand the flows more.
Okay, so that was domestic regulatory panic.
Yeah.
But it was soon completely overshadowed by the global tsunami, right? The 2008 global financial crisis.
Yes, the GFC. On January 21, 2008, amid rapidly escalating fears of a full-blown U.S. recession stemming from the subprime mortgage crisis imploding, the Sensex recorded what was then its highest single-day loss at close, a fall of 1,408 points.
And the volatility didn't stop there.
No, it spilled right into the next day, January 22nd. The fall was so swift after the market opened that the index hit the lower circuit breaker again, barely a minute into trading. Trading was suspended for an hour. That was the first time that had happened due to a circuit limit since way back in 2004. This was pure global contagion in action.
Sheer fear driving the index lower and lower throughout 2008.
Relentlessly lower. By October 17, 2008, it crashed below that major psychological threshold, the 10,000 mark again, closing at 9,975. wiping out years of gains in months.
And what was the absolute lowest point during that immediate crisis period?
The lowest close during the crisis, and its lowest point since way back in November 2005, was recorded just 10 days later, on October 27, 2008. The Sensex closed at a sobering 8,509.56 points.
Less than half its peak value from less than a year earlier.
Devastating.
This whole 2008 period is just crucial, isn't it? Because it vividly highlights that even if India's domestic economy had its own resilience, the Sensex, as a financial market index, is absolutely not insulated from systemic global crises.
Not at all. The interconnectivity of modern finance is just too deep. A mortgage crisis originating in the U.S. housing market can directly lead to trading suspensions in Asia's oldest stock exchange. That link is undeniable. ##C, the modern acceleration, 2014 to present.
Okay, so following the recovery from the depths of 2008, the next phase, particularly from around 2014 onwards, saw the pace of growth accelerate dramatically again. This really signaled India's emergence, perhaps, as a truly mature and ambitious global economic power.
And 2014 itself was a really pivotal year, wasn't it? Defined by a couple of major achievements according to the sources.
Yes, firstly, purely in terms of milestones, it was a record-breaking year. The Sensex crossed 7 distinct 1,000-point milestones within that single calendar year, just relentless upward movement.
7,000 points gained in milestones in 1 year. But there was something else, perhaps more symbolically important. Something about Hong Kong.
Right. In March 2014, the Sensex actually closed higher than Hong Kong's benchmark index, the Hang Seng Index, for the first time ever.
Wow, that feels significant. It wasn't just a numerical fact, it felt like a symbolic turning point in the hierarchy of Asian financial markets. It helped cement the Sensex's growing reputation, maybe making it Asia's highest value index at that point, reflecting a potential shift in global investor focus towards India's vast domestic consumption story and its long-term growth potential.
And the biggest domestic catalyst that year came in May 2014, right? Politics again.
Politics again, absolutely. Driven by the decisive victory of the BJP-led NDA coalition, winning a clear majority in the general election, the index crossed 25,000 points for the first time. That specific day saw a massive rise of over 556 points in a single session.
Why such a jump?
Purely driven by hopes. Hopes for stable, decisive, reform-minded government that could provide long-term policy clarity and potentially unlock faster economic growth after years of coalition politics.
So the market was betting on reform and stability.
Big time. And the upward momentum generally continued over the next few years, powered by various policy actions, increased government spending on infrastructure, and continued strong FII inflows. The 30,000 mark was initially breached intraday back in March 2015, partly following some key interest rate cuts by the Reserve Bank of India aimed at boosting liquidity.
But it didn't close above 30K then.
No, it took a while longer to consolidate at that level. It finally closed decisively above 30,000 2 years later on April 26, 2017.
Okay, so steady progress. But history teaches us that stability is always temporary. The COVID-19 period, starting in early 2020, must have represented the greatest short-term volatility in the index's entire history.
Without a doubt. It showcased both extreme, unprecedented fear and then eventually incredible resilience. The initial impact, though, was absolutely devastating.
What were the numbers like?
On March 12, 2020, as the world was just starting to grasp the terrifying scale of the pandemic, the index plunged by 2,919.26 points. That single-day fall wiped off a staggering amount, something like 11.2 lakh crores of shareholder wealth. It was the second worst single-day point fall up to that point.
2,900 points. Just gone. And circuit breakers kicked in again.
Immediately. The very next day, March 13th, trading was halted completely for 45 minutes soon after opening. That was the first time the lower circuit breaker had forced a halt since the global financial crisis back in 2008. Pure panic selling.
And the ultimate crash came with the lockdown announcement.
Yes, March 23, 2020. That day saw the Sensex experience its largest single-day point loss ever recorded, a plunge of 3,934.72 points. It closed near the 25,900 level. That was the moment of maximum fear, maximum uncertainty about the future.
3,900 points in one day. Unbelievable. But what followed was almost equally unbelievable, wasn't it? The recovery.
Astonishing. Almost a perfect V-shaped recovery, fueled by massive global liquidity injections from central banks worldwide, huge government stimulus packages, and eventually optimism about vaccines and economic reopening. Since that crash in March 2020, the index's acceleration has been nothing short of breathtaking.
Let's tick off those milestones, the sources say.
The sources confirm this explosive recovery phase. The N6 hit 50,000 points in January 2021. Then, incredibly, just 8 months later, it crossed 60,000 points in September 2021.
50 to 60,000 in 8 months.
Unprecedented speed at those levels. It then took just over 2 more years to reach 70,000 points in November 2023. And then, even more recently, in July 2024, it crossed the 80,000 mark.
Just relentless upward momentum post-COVID. But even within this intense period, politics can still deliver massive shocks, right? Your sources mentioned a huge drop in June 2024.
Yes, a sharp reminder that political risk never disappears entirely. A massive single-day drop of 4,389.73 points occurred on June 4th, 2024.
4,300 points. What happened?
This was directly attributed to the Lok Sabha election results coming in differently than many market participants had expected or priced in. It highlights that political uncertainty, or even just election outcomes deviating from consensus, remains a key driver of significant market volatility, even when the index is near historic highs.
So that recent volatility just confirms the whole history we've reviewed. The Sensex acts as this immediate, incredibly sensitive barometer. It tracks economic prosperity, yes, but also political stability, global events, regulatory changes with remarkable precision.
Absolutely. And its latest value, that 85,037.08 points we mentioned at the start, while subject to daily fluctuations, is fundamentally a testament to the long-term structural growth story of the Indian economy over decades. #tag 6 to suffocance and application.
Okay, we've firmly established the Sensex as the 30-stock benchmark for the BSE. However, anyone looking at the Indian market quickly encounters another major index, the Nifty Y50. For our listener trying to get a really thorough understanding, what's the crucial distinction between these two giants? They seem similar but different. #tag A, the Sensex versus Nifty 50.
Yeah, it's a common point of confusion, but the fundamental difference is actually quite simple. It comes down to the exchange they belong to and the size of the basket they track. But those simple differences have deeper implications.
Okay, so Sensex belongs to.
The Sensex is the benchmark of the Bombay Stock Exchange, BSE, and as we've drilled down, constitutes 30 top companies. The Nifty Y50, on the other hand, is the benchmark index of the National Stock Exchange, NSE, India's other major, slightly newer exchange. And as the name suggests, it consists of 50 top companies.
BSE versus NSE,
Yeah.
30 stocks versus 50 stocks. I know most of the really big liquid stocks, they're probably listed on both exchanges, right? So they must share many of the same huge companies like Reliance, HDFC Bank.
Oh, yes, absolutely. The overlap in the top constituents is very significant. Many of the largest, most actively traded stocks are dual listed. But what does that difference 30 versus 50 actually mean in practice for an investor or someone tracking the market?
Yeah, what's the implication?
The main implication is concentration risk or diversification. The Sensex, by definition, is considered more concentrated because its value is derived from only those 30 elite firms.
More concentrated meaning.
Meaning, given that the calculation uses free-float capitalization weighting, a significant change in the price of just one or two of the absolute mega-cap stocks, think Reliance Industries or HDFC Bank, again, will have a disproportionately large impact on the overall Sensex index value compared to its impact on the Nifty way.
Ah, okay. So because the Nifty 50 is broader, with 50 companies instead of 30, it offers inherently better diversification. The influence of any single company is somewhat diluted.
Precisely. The Nifty 50 might be considered by some as a slightly truer reflection of the broader market health, simply because it draws from a wider pool and is less susceptible to idiosyncratic moves in just one or two giant stocks.
So does that make the Sensex more volatile?
It tends to be, yes, slightly more volatile precisely because of this concentration. Fund managers, professional traders, they often track both indices closely, but the Sensex often captures the rapid market moves, both up and down, perhaps more intensely, which in a way makes it arguably the more sensitive index, really living up to its name, #B, while Sensex matters. Advantages.
Okay, so we understand the mechanics and the comparison with Nifty. But moving beyond just tracking numbers, what are the tangible benefits and real-world applications of the Sensex? What elevates it from just being a measure to being a financial necessity?
Well, the advantages really radiate outwards. They affect the companies that get included, they affect the domestic financial industry, and they definitely affect the international perception of India as an investment destination. For the companies themselves, inclusion is a massive privilege.
How so? For those elite 30.
Firstly, the increase in visibility and reputation is undeniable. Being included in the Sensex enhances a company's standing almost overnight. It becomes a verified blue-chip firm in the eyes of the market, which can directly leverage its overall valuation and certainly strengthens investor confidence, both domestically and globally.
Okay, reputation boost. What else? Does it help them financially?
Significantly, it grants them tangible financial leverage. Being part of the Sensex typically opens doors for easier and often cheaper access to capital markets. It can make it more efficient for the enterprise to raise new share capital when needed, and it provides a stronger currency, its own stock, for pursuing large-scale growth opportunities like mergers, expansions, or acquisitions.
Right. And for the wider finance industry, how's it used?
For the finance industry globally, it serves as the fundamental investment benchmark. Fund managers, whether they're running domestic Indian equity funds or international emerging market funds, constantly use the Sensex to measure the performance of their actively managed funds. Are they beating the market or lagging it? Investors also use it to evaluate the success and the risk profile of their own portfolios relative to the broader market trend.
So it's the yardstick.
It's the primary yardstick for large-cap Indian equity. And perhaps most critically, especially from an international perspective, it functions as the definitive foreign investment gauge.
How did that work?
International investors, global risk analysts, sovereign wealth funds, they track the Sensex very closely. Its level and its trajectory are seen as key indicators of India's economic stability, the effectiveness of its regulatory environment, and its overall growth potential before they commit potentially trillions of dollars in foreign capital into the country. A rising Sensex signals opportunity and stability to them.
And when you look at the long-term performance data provided in the sources, that appeal becomes crystal clear, doesn't it?
Absolutely. Using historical information compiled all the way back from April 1979 onwards, the long-run average rate of return on the S&P BSE Sensex works out to be, well, it's a substantial and hugely attractive 18.6% per annum.
18.6%. Compounded annually over decades.
Over decades. That single figure is a massive testament to the power of India's long-term economic growth story and the wealth creation potential of its leading companies. It explains why global investors pay such close attention. #TC. How to invest in the Sensex, gaining exposure.
Okay, given its historical importance and that really impressive long-term return, many listeners will naturally be wondering, how can I invest in this? How do I get exposure to the Sensex? But it's not like buying a single stock, right?
No, exactly. It's important to clarify the process. You cannot buy the Sensex index directly. It's just a number, a calculation. And also, the BSE itself, the exchange, doesn't allow direct retail purchase or sale of securities for the general public. You have to go through registered intermediaries and use specific financial instruments designed to track the index.
Right. So first things first, there are some administrative prerequisites in India, aren't there? Things you absolutely need before you can invest in anything stock market related.
Yes, these are non-negotiable. To invest in Sensex-linked products, or any Indian equities for that matter, you need a Dnyan account. That's the electronic repository where your shares are held securely.
Dnyan, got it. Like a digital vault for shares.
Exactly. Then you must register for a trading account. This is the account linked to a broker that actually allows you to place buy and sell orders for securities online or through your broker.
Okay, Dnyan to hold, trading to transact, what else?
You also obviously need a functioning bank account linked to your trading and Dnyan accounts for funds transfer. And critically, you need a verified PAN card, which is India's permanent account number, essential for all financial transactions and tax purposes.
Okay, Dnyan, trading, bank, PAN. Once you have those foundational requirements sorted out, how can investors actually get exposure to the Sensex's performance without having to individually research and buy all 30 underlying stocks, which would be complex and expensive?
Right. Buying all 30 in the correct proportions is impractical for most. Luckily, there are several well-established and accessible ways. The most common, especially for long-term retail investors, is through index funds.
Index funds, how do they work?
These are basically a type of mutual fund. Their specific mandate, their only job really, is to replicate the Sensex composition perfectly. The fund manager buys shares of the 30 constituent stocks in the exact same proportions, the same weights as they have in the index itself. Their goal isn't to beat the index, just to match its performance minus a small fee.
So it's a simple, passive way to ride the Sensex's performance.
Very simple, very popular. Secondly, and increasingly popular, are exchange-traded funds, or ETFs.
ETFs, how are they different from index mutual funds?
They are very similar in that they also track the Sensex passively. The key difference is how they are traded. ETFs are bought and sold directly on the stock exchange throughout the trading day, just like individual stocks.
Ah, so you can buy or sell them anytime the market is open.
Exactly. This provides investors with high intraday liquidity, which mutual funds typically don't offer. You usually buy, sell mutual funds at the end of day price. ETFs also often carry even lower expense ratios than traditional index mutual funds, making them very cost effective.
Okay, index funds and ETFs for straightforward tracking. What about more sophisticated investors?
For the more sophisticated investor, perhaps interested in short-term trading, hedging existing portfolios, or speculation, there are derivatives.
Derivatives like futures and options.
Precisely. There are active markets for futures and options contracts based directly on the Sensex index level. These allow investors to make leveraged bets on the index's future direction, up or down, or to hedge their existing equity portfolios against potential adverse market movements, all without actually owning the underlying basket of 30 physical shares. Much higher risk, much higher complexity, but available. So we've really covered a lot of ground in this deep dive. We've charted a pretty complex path, haven't we? We defined the Sensex as that crucial 30-stock benchmark of the BSE. We unpacked that critical shift from full market cap to the globally accepted free float calculation method.
Right, the sensitivity aspect.
Exactly. We looked at the stringent, multifaceted rules for inclusion in that elite group of 30, and we navigated the real roller coaster history, the high-speed rallies, the shocking scams like Hershad Mehta's, and those moments of intense global panic in 2008 and again during COVID in 2020.
Yeah, it's clear that this index is far more than just some static numerical score keeping track of stocks. It really is a dynamic, actively managed historical document. It tells the ongoing story of India's economic development, warts and all.
That's a great way to put it. The Sensex truly charts India's profound evolution from being a relatively closed, cautious economy back in the 1970s and 80s to its current status as, undeniably, one of the world's fastest-growing and most dynamic major economies. Its fluctuations, its ups and downs, are a direct result of major policy reforms, unavoidable global financial crises, and the continuously shifting landscape of both domestic and international investor sentiment.
And as we've noted, that index committee is always working, ensuring the Sensex composition is constantly changing, constantly being updated to reflect what they call the current market conditions. Which brings us, I think, to a crucial final thought for you, our listener, to consider as you digest all this knowledge.
Given that remarkable long-run annual rate of return, we talked about 18.6% over decades, and considering the very recent, very symbolic additions to the index, like Adani Ports reflecting that massive national push on infrastructure, and Zomato representing the explosion of the digital consumer economy.
Yeah, those felt like landmark changes.
They did. So, do these choices signal a definitive pivot? Is the index's future growth story going to rely less on the legacy industrial players, the old guard that defined the index's early decades, and lean much more heavily now on infrastructure, logistics, and particularly the burgeoning digital consumer technology space?
In other words, is the fundamental nature of India's economic pulse itself undergoing a transformation right now? A transformation captured precisely, maybe even anticipated, by the changing faces within the Sensex constituents.
That structural shift, that tension between the old and the new economy within the index itself, that's really the fundamental narrative challenge and opportunity facing the Indian market today.
Definitely something to keep watching. Thank you for joining us on this deep dive into the Sensex. We really hope this knowledge provides a valuable and hopefully comprehensive lens through which you can view India's incredibly exciting and rapidly evolving financial landscape.